Hi there, everyone. Thank you so much for joining us today. I'm Marche, the webinar director here at Advice Chaser, and I want to welcome you as you're coming in the webinar room. And before we introduce our guest, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're so thrilled to bring you this educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries during or after the presentation today as appropriate. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information as well. We'll be happy to reach out after the event to make sure that gets addressed. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our presenter today. Brenda Bridges is a financial advisor, retirement income certified professional, certified divorce financial analyst, and founder of Bridging Wealth Solutions. With a focus on clients' needs, Brenda approaches each with the same process: listen, reflect, and act. Her strong belief in ongoing education keeps her current in ideas and trends. Brenda is proud to offer her clients options and education. She is passionate about guiding them to a stable, healthy financial future and the freedom that delivers. She's extremely proud to have helped hundreds of clients with the financial and divorce planning over the last decade. And Brenda, we have had you on many times for your divorce expertise, but I know that I said, let's talk about just anyone who is in a relationship who's planning for retirement. And I know you have kind of a unique perspective on that, having seen the divorce side of things and blended families. And so really excited to have you back, and I'll turn the time over to you.
Thank you, Marche. I'm really excited to be back. Talking to people about retirement is also one of my passion projects. So we call it those 10 things couples should do. It can be just as pertinent if you are not part of a couple, but we'll try to call out as we go along where those differences might be. I do want to say, although this isn't really interactive, I would love for it to be as interactive as possible. So we'll try to take a pause and key into the chat. If we talk about a specific topic and you have a question, throw it in the chat. We'll try to answer it right then. I'm going to caveat it that if it is specific financial advice, you really want to take that offline and have it personalized to you and your situation. So I'll be speaking in generalities when we're addressing these things today. And if it is something that either would require a really long explanation, then Advice Chasers does an amazing job of just circling back and making sure you get the answer to the question you're asking. This may or may not be the forum. So we're going to make a judgment call on that as we go through it, but we'll try to address everything that comes up. Okay, here we go. Okay, so this term, I don't know, you may or may not have seen it, the red zone. Is becoming more and more popular. And I believe one of the most pertinent things in retirement planning and one of the least acknowledged practices or items. What the red zone is, it comes from a football analogy, right? So I'm not a huge football fan, and I couldn't tell other than probably quarterback and center what the players are. But I do get this from having been in enough Super Bowl parties and watched them and so on. The red zone is the 20 yards before scoring, right? So it's the make or break difference where the team is going to cross the other team's goal line and score or not. That is known as the red zone. So that's been kind of lifted and transferred over to retirement planning vernacular in the last 5 years. And then the next 5 years with retirement in the middle are critical to how successful you are in retirement. And this is a mindset shift, right? Because retirement there are a lot of them going on now, but retirement tends to have been viewed as you're going to work, stop work, and then you're retired, move on. And all the shifts and changes that are made at that point when you retire. And a newer, more modern, and more pertinent to these economic times we're in view is you really want to look at the 5-year runway before your retirement, start understanding your options, and start making little shifts to reposition yourself so that at that point that you do retire, whatever it looks like for you, because different people have different plans and goals and wishes and visions for their retirement, but whatever that is that you have spent, I get excited and I talk fast, so if I need to slow down, give me a signal, so that you've spent that runway, right, up to the point where you're not working anymore, getting yourself positioned in the best way possible for retirement. Sorry, just look at the chat and got a little bit distracted. So let's see. Yeah, don't wait until retirement is right around the corner. Kind of part of that all goes without saying. What we're going to talk about today are the different ways that you can look at positioning yourself for a really happy, healthy, well-prepared retirement. And just one little caveat, I don't have the exact percentage, but a huge majority of people who retire actually retire before the time they planned due to a job consideration, the economy, health, taking care of other people, whatever the reason is. It's really frequent that if I'm saying I'm going to retire when I'm 67, that might actually be 64 or 65. So the sooner you start planning for that date, the less likely you are to be taken unawares. And if your runway is shortened for whatever reason, the more likely you're going to be able to survive and thrive through that, rather than being not ready for what's hit you and not financially prepared. Here we go.
We do have a question here though. And this is the question. I understand why 5 years prior to retirement is critical, but why is it 5 years after retirement?
So there can be a lot of reasons. The most frequent, I would say, from a planning point of view, isn't spreadsheets. It's not what the market is doing, is that when you actually get into your retirement world, it's different than you anticipated. Frequently people will say, and we touch on this a little more in the presentation, but broad-based, frequently people will be like, oh, in retirement, my life is going to look like, I'm going to spend summers at the cabin, and I'm going to spend, every holiday visiting my grandchildren as they're spread throughout the country, and I'm going to take classes at the community college, and so on and so on. When what in fact might happen, it could be entirely different. So in that 5 years when you stop working, a lot of times people decide that they didn't want to stop working. They just stopped wanting to do what they were doing, and then they go on to their passion project, and that reshapes how retirement looks. It might reshape their expenses. Their children might move, who knows, life happens, right? But it tends to shift our outlook, the way we go through life and our finances right after retirement as well. After that, things tend to settle down. It's not as though life doesn't change as much, but it becomes more reliable.
All right, thanks for that answer there.
Okay, this is a big mindset one. I always recommend to my clients, or when I do workshops and webinars, start with mindset. Start with what do you want your life to look like? Take some time, if you're a journaler, journal. shut your eyes, dream. Like really think about not, do you need to have a 4% withdrawal rate? All fine and good. And it's an important part. And in my mind, it's not the most important part. It's really important to understand what your goals are or you can't hit them. And that is, what do you want your life to look like? Do you want to travel? Don't you want to travel? Do you want a second home? Do you want to snowboard? What do you want it to look like? And then next level, this is, what are your worries? Like, where's the gap? What are your fears? So you establish your grand vision and then look at where you are today and identify, and this is what those 5 years are for, more if you want to take them, less if that's what you have. But identify, where are your potential potholes or points that can trip you up? And then you can start to work away at that. So when you're understanding how you're looking at and feeling about retirement, you also want to have these conversations as a couple, because I know personally so many people who one of the spouses has retired and then suddenly they're home all time in retirement and the other goes back to work because this is not their vision. They've been used to having their own rhythm and routine and take a look at how things are unfolding and say, I want a little space, or I want some extra income, whatever it might be. So you want to look at your visions individually, but also put them together. So you're communicating not only about what you want things to look like in your life to be, because it's a huge shift, but also respecting one another's individual visions and how it impacts your life together. And I know we're talking about finances, so let's throw that in, and your finances. It's really, really important. Another part of this might be, are you like, identify, are you kicking the can down the road? Meaning, are you like, not concerned, I'll deal with it when it happens. I'm not retiring for 4 years, so I don't have to think about retiring for 3 years and 50 days. You're increasing the chances of not living the life that you want to live and not being empowered and in control of that if you're not facing those things. So you might be not concerned because you look at your finances and you say, we are good, you know, we have saved all the money, we have paid off our house, we know healthcare is going to be expensive, we're ready for it. If that's why you're not concerned, kudos to you, right? You've done the work. If you're not concerned because you don't want to look at it and you fear that you're not going to have enough, that your lifestyle is going to be dramatically impacted, I urge you to dig deep and take the look, even though it's hard. And there are so many financial advisors out there who are able to assist you through this. You would be surprised what tiny shifts, especially tiny shifts over time, what a difference that could make. So again, if you're not looking at your situation because you already did all the planning and you feel awesome about it, perfect. But if you're not looking because you're afraid of what you'll find, take a deep breath, look under the hood, see what you can change now and adjust now. Okay, number 2. So spending is different in retirement. And it's usually not different in the way you think it will be. Often people think that they're going to spend half in retirement of what they did during their, regular day-to-day life when they were working. But when you think about it, you have a lot more time to fill. You perhaps were in a situation where you were saving life for down the road when you had that time to do it for the travel and the eating out. You might just be tired of cooking anymore. So that budget goes up, whatever it is. Usually people spend as much or more in the first few years of retirement than at least they had planned on or expect. Other points that we're making here, and kind of looking at spending 2 different ways, but from an investment point of view, we are very well versed in saving, whether it's, make sure you get the free money in your 401k if there's a match. Make sure that you're putting away X percent. 15, so you know is ideal. 20 is even better. 3 is probably not going to get you to where you want to go. But we do know in our country that savings for retirement is an important part of our financial picture, right? What we're coming to learn as a society is spending in retirement. So we call it decumulation, right? You're accumulating and spending to get that nest egg, and then you start spending down the nest egg, and it takes a mindset shift in how you're looking at that money and planning for spending the money. And again, we'll touch on this a little later, but the old investing rules of keep saving money, just become more conservative, less aggressive as you're saving that money, and then you're going to be fine in retirement at a set retirement withdrawal rate. It used to be 4%. Now most experts are down to 3%. That is kind of an old school way of thinking, and more in modern portfolio theory, which goes back to the 1950s. So it's no longer modern. What we'd like to do, a lot of financial advisors who follow what we call a bucket strategy, is in decumulation, spending down your assets. What you're doing is making a plan for what you're going to need and when. And it's been, and this is, I don't want to get in the weeds on investment strategies, but talk to your financial advisor. If you don't have one, talk to a financial advisor about different ways to plan for spending down. So the old investing rules of just withdraw 4%, 4% is probably too high. So it's more likely 3, even if you're following that methodology. If you're becoming more conservative at the same time, you're leaving money on the table. It's not growing as quickly. And then if you counted on taking more out, just simple math, you're getting to 0 faster. Whereas if you, in bucket strategy, you look for, what do I need this money for and when? And you make sure that you have a safety net of like short-term money. So you're not going to be in a position, like I'm sure many of you, if you're facing retirement, are highly in tune with what the market's been doing this year. And if you don't want to be in a position where, you know, I'm picking up my phone here, looking up Market Watch or seeing what the S&P is doing every day and how that's going to affect your withdrawal rate, then make sure that you have funded your short term and it's not going to be impacted by the market crazy. So you've got a foundation. And then what that allows is for your long-term money to be invested more aggressively, because you don't need to touch it for a while. So shaping your spending or your using of all that you saved for in a way that's built around your lifestyle and spending instead of percentages is a much, in my point of view, safer way of looking at retirement, how long your money is going to last, which is everyone's number one fear talking about retirement. Am I going to run out of money? And then what does it look like? So you're better able to get a handle on what that looks like. And if you're doing it 5 years, 4 years, 3 years before, you can start making these shifts. So you're not shifting things in a market like this all at once, where we're having a lot of down days. You're doing it over time with a plan. And just, if you're in retirement, so if someone retired last year and this year we're looking at a year-to-date down, I think we're down 10. And no, flip that, year-to-date we're down 12. Running year to year, we're down 10% in the market. So if they had $1 million saved, now they have 900,000. That's a huge difference in what you're going to be able to spend and how it can impact you. So critical is have a plan. So if that happens, you're okay. You planned for it and you know how your finances are going to look, as opposed to going, holy cow, I got to go, you know, I have to go back to work, or we really have to cut our spending, or whatever the case may be. Okay, that was a long one. Sorry.
That's okay. I think a lot of people are worried about that in general, and so that's good to cover at the top of
Yeah,
the
it
presentation.
it does. It has huge impact. And like, I'll have people when you meet them and talk about what you do, and they go, "Oh, gee, I bet your phone's ringing off the hook." It's like, no, actually, it's not, because all my clients have a plan. Like, they're prepared because the market is going to do this. We've gotten used to it only goes up for a long time. So it's shocking to a lot of people, but it's going to do it. And it's going to do it again. We just have no idea when. So as long as we have a plan that accounts for it, then you can sleep much better at night. Another thing to look for as you are making your plan, as you're working with your advisor, as you're laying things out, is how are taxes going to impact? And this is one of the it's frequently a big miss in planning, because people will shove away all that they can in their ERISA accounts or their retirement accounts, their IRA accounts, to get the tax benefit now. Lovely benefit, perfectly understandable. But we also have to look at, when you do that, you're not paying taxes on what you put in. If it sits in there for 20 years, 10 years, however long, with compound interest and grows, and then you pull it out, you're being taxed on the entire amount as income. And if our tax rate shifts, then it's going to be whatever that current tax rate is. So key right now is our current tax law sunsets in 2026, meaning it goes away and it reverts back to where we were in, I believe, 2018. There were higher rates. So if we're in 2022, if you're planning to retire 2026, 2027, we can't see into the future. We don't know what Congress is going to do about taxes, but where we stand currently and what we need to plan for is a higher tax rate when you're going to be withdrawing that money, and you're going to be withdrawing that money to live on, paying taxes on all of it in there. So if, as you're putting your plan together, you're looking down the road for, am I going to be in my buckets? Am I going to be paying tax on all of this, every single dollar I withdraw? Or is there a way for me to fast forward that in our low tax environment and pay taxes now, so that down the road I have choices and I can do things like balance my tax bracket? If you're able to say, I'm going to take a little less from this bucket and a little more from this bucket, and that's going to save me 1 or 2% in taxes just because of the way I've managed it, you're likely going to be better off, and that 1 or 2% will make a difference over time. And that's withdrawing, right? If you're still contributing, it's also a really good time, if all of your money is in retirement and you do have some time, to look at converting that and paying the taxes now. So basically paying them forward if it makes sense to you or in your overall plan, so that you have options. And if your tax bracket, even though your income is higher now, you might be paying less in taxes. So if you can shift that money, so down the road you're not paying any taxes on some of it, all the better. Whole idea is, don't disregard taxes, because plenty a person has been dismayed when they're in retirement and they're pulling that money out and they're paying taxes on all of it, especially if you believe taxes are going to go up, income taxes.
So a question here is, if I anticipating to be spending more even in retirement in the first couple of years, it's likely the tax bracket I'm in may have higher tax brackets, correct?
Well, they're kind of two different things. So if you're spending more, let's flip it and answer the second part first. It is, if you are earning the same amount as we currently stand, your taxes will probably be higher. If the law shifts, depends on how you're looking at it and what you believe. But in our current scenario, the same $200,000 in 5 years is going to be taxed at a higher rate. Then the second part of the question asked first was about spending. Your spending doesn't really reflect on your taxes. What will happen is, if you're taxed more, you're going to have less to spend, just because it went the way of income taxes. And then if you have less to spend, but you're looking to travel and use your, newly found free time, you might be faced with some unanticipated decisions where your budget, what you want to spend, isn't supported by your income. And part of the reason for that, this is kind of going down a windy road, but part of the reason for that might be because you're paying taxes on everything.
Thank you for that answer. That's
Did that work? Did that make sense?
Yeah, looking at it from the opposite end makes sense now. Yeah.
A big thing in retirement is, where do you want to live? Are you making your plan based on staying in your current home, in your current community? Do you want to downsize? And when we were doing planning for this, Marcia made the comment, well, a lot of people downsize, but it costs more, which is oh so true. You might have a smaller footprint in your home, but it might be your dream house you've waited for all this time. It might actually cost more to support. And of course, we're also looking right now at real estate due to COVID and at the economic situation going up, being less available, interest rates going up. We can't control any of that. The other part is, will you move? Will you move to, out of the city into a more rural place? Will you move from the state you're in that has high income tax to a state that has no income tax? That will all impact your planning. And I urge you to look at the broad picture, and there are tons of reports on this, but it's not just income tax. If you tend to spend a lot of income and you move from a state that has low sales tax to a state that has 10% sales tax, 10% is a lot. So that's going to diminish your spending power. So don't just get caught up in the income tax point of view or the cost of the housing. Look at all the things that can affect, if you plan to move, what that looks like. Sales taxes, property taxes. You might look at their estate tax situation. That, some states are very friendly and easy, some are not. So look at the complete picture in your plan, not just the house costs less, because if it's outweighed by all the other costs that are associated with it, and they might really try to dig in and think about what life would look like. We're in a situation where together we have 6 children, all in different cities. So, and none of them are the city we live in. So a lot of time is spent and travel, and there's a cost to that. So we love to go visit them, but that's an unanticipated consequence of moving to a lovely smaller market, but having the people we love and want to see somewhere else. What's that going to look like? So just an example of. Let's look at number 5. Social Security. So huge role in retirement, depending on your financial situation. For a lot of people, depending on what's been saved, this might be a significant amount. For others, not so much. But you want to look at, when you turn on that faucet of Social Security, how it impacts you. You look at things like longevity. Does it run in your family? If that's the case, you may want to turn it on later for a much higher amount, because every year up to full retirement age, you don't take Social Security. You basically give yourself a pay raise, right? But if you have not a lot of longevity in your family, you might want to take it earlier and take the lesser amount, so you're getting something. There's a lot of qualitative consideration going into it beyond just the math of, I get this year, this year, and this year. So some ideas of things to consider in retirement. You might also look at balancing not taking Social Security and being okay with taking a bigger chunk of your saved income, knowing that, that 8% you're going to get every year from holding on taking Social Security is more than going to pay for it. All comes down to having a plan. One thing that a lot of people don't recognize or realize that is important is Social Security, the staff at a Social Security office can be highly trained, very useful. They can only answer the questions that are posed to them. They can't advise you, so they can't take on the role of a financial advisor. So if someone goes into the Social Security office and says, okay, hey, this is my situation, when should I take Social Security? They cannot and should not tell you the answer because they don't know, they don't have a full picture. They can answer a very factual question. If I retire at this age on this date, what will my payment be? Yes. But you have to have the question to get the answer. So don't expect to go into your local Social Security office and use them as a financial advisor because that's not their role. They also are not going to if-then situations with you in the same way. So that last thing that we talked about, well, okay, if I take my savings and I take a little bit more to live for 2 years so that I don't take Social Security for the next 2 years, what's that look like? That's not what they're walking through with you. They're there to give you really specific answers about what your benefit is and how it can be impacted. Okay, healthcare, the bugaboo of the last 30 or 40 years. Make sure you plan for it. Some people are lucky and they have healthcare through an employer. They have healthcare through an employer, through retirement. My father still has his healthcare paid. It's amazing. I pay for my own healthcare because I'm independent. So I need to look at what's that going to look up to 65, so Medicare age, but then what's it going to look like after? And this goes for everyone. Frequently, the thought is, I hit 65, I'm eligible for Medicare, I'm good. But the average cost right now for a couple retiring right now is $315,000 in healthcare costs beyond Medicare. So it's really important not to get it into your psyche that, oh, I hit Medicare and I'm, 100% being taken care of, because it is, says it right there, one of the biggest expenses you're likely to have. And I would think we all want to be in a place where if we need appropriate care, we're able to afford it. Another thing, and this can get rightfully confusing, is healthcare costs are not the same as long-term care costs. So healthcare, right, is actually dealing with an illness or wellness care, the state of your health, should you need it. Long-term care is providing you care in case you're not able to physically care for yourself. We call it the acts of daily living. So if you're not able to feed yourself, dress yourself, support yourself, so move, go to the bathroom on your own. If you're not able to do that, that is a long-term care cost. That is not a healthcare cost. So ideally, especially if you're a woman, because we're more likely to be solo and we're more likely to live longer, you've got some safety net of long-term care. I could do a whole hour on that or more. So get yourself educated on Medicare. That flows through. When you're signing up for Medicare, those decisions you make at that time can follow you down the road. So it's going to behoove you, right? It's going to pay to look at your options with a long-term point of view. So you might say, oh, 65, I'm eligible, but I plan to work for 3 more years. So I'm going to decline a whole bunch of this because I don't need it till later. Perfectly understandable. But sometimes when you decline it, you can't get it back. So you just want to be very clear when you're working with us. And I totally recommend work with a specialist. You don't have to pay them. Usually they are compensated by the company that you sign up with. This isn't going to be all the time. I want to caveat everything. You might find a Medicare specialist who is going to charge you a consulting fee. Usually they are paid by the carrier, the insurance carrier that they enroll you or sign you up with. But try to be really smart about the questions you're asking them. Do they only represent one company or do they represent multiple companies? Are they able, if you do move to a different state, Are they able to help you? Can they recommend someone that will help you? Will they revisit this with you every year? If they recommend a change, why are they recommending a change? All the things. But also, if you make this decision now when you're 65, how can that impact you next year and the year after and the year after? So that they're laying out, here are the pros and cons. And if you decline pharmaceutical coverage now, because you have it with your employer for 3 years, and then you're fine, you're not sick, everything's great. But 5 years from now, you're no longer employed and you didn't elect it, what happens? So have them walk through with you different scenarios and how it might impact you. In that particular case, you could very well be back paying at a higher rate for not signing up. So it can cost money and add up. It can also limit your care choices down the road. So long-term care costs. So we talked a little bit about long-term care and what it is. If you aren't able to care for yourself, it allows funds to augment that or completely care for it. There are a lot of different situations. We tend to go to the most extreme, need to live in a nursing home, can't care for oneself, period. There might be a lot of other cases where you would benefit from long-term care. It could be, so long-term is usually, depends on the policy, a 90-day elimination period. So that elimination period means they aren't paying a thing. You have to be long-term needing care. So for 90 days, some go up to 6 months. You're paying out of your own pocket or whatever augmenting insurance for that care. After 90 days, if that's your elimination period, then the long-term care kicks in and it helps pay for whatever care you need. You want to, last point on this, know your policy and know what that will be, like what will it care for. There are some policies that will only pay for outside care at a medical facility or nursing home. There are some policies who say, here is your check, you use it however you want. If it's groceries, a cruise, the electric bill, whatever it might be, it's to augment your expenses while you're not able to care for yourself. Some policies allow to pay for a family member. So if someone is ill and their niece is able to come in while they're going to college and spend 8 hours a day caring for them, they may be able to use the policy to pay them, they may not. So there's a lot of, just know the details if you have a long-term care policy of what it will provide you. There are a lot of really new innovative ways of dealing with long-term care that allow flexibility. So they're not think of your auto insurance, right? You pay for it, you hope you never need it, but in case you're in an accident, you're really happy you have it. There are a lot of long-term care policies that work just that way. So you pay for it, you hope you pass away quietly yesterday in your sleep with no pain, surrounded by your loved ones. But just in case you need it, you have it. But there's no value to it. You're not building anything. You're just paying the premiums like an auto insurance policy. There are other long-term care policies that can actually accumulate wealth. They can pass on the benefit. If you do pass away and never need it, then someone else gets that benefit via life insurance or a wealth transfer. So there's a lot of flexibility now that didn't exist in the 90s when long-term, I'm using my hands a lot, when long-term care started. So I think it's a very, very important part of the plan, because having a long-term care, what the industry calls triggering event, which means you need it, can totally derail your plan. If even someone recovers from an illness, but say it takes them 2 years, and during that 2 years, they need medical care, they need out of home or in-home health care and so on. And we know that's expensive, right? I will share with you, my mother has Alzheimer's and her care is $5,000 a month. And that's not for medical. That's just to live and have people caring for her. That was not part of my parents' retirement plan. And they don't have long-term care insurance. So that is an out-of-pocket expense that will go on as long as she needs care. So you can imagine if you saved $500,000 for retirement and you find yourself in a situation where you're paying $60,000 a year for one in the couple to be provided for, to have the care that they need, that $500,000 is gonna decline pretty quickly. So other things with long-term care to take into consideration are, who do you want caring for you? For some people, they may dearly want to be able to compensate their children for living in the mother-in-law suite and caring for them when they can't care for themselves. For others, it might be really important that they have a level of independence and that they don't feel like they are relying on their children, or being a burden is something we often hear, on their children to care for them. So they want to have the ability to live in another facility, a space where they're well cared for. So the quality of care isn't of a lower level, but they have the, the word that comes to mind is dignity, but that's not a good word because we can have dignity in all things, right? But that they're still feeling empowered in that they are taking care of themselves, as opposed to relying on someone else to take care of them. Neither is good or bad. They're different ways. But if you take a look at, if you want to make sure in the case you can't take care of yourself physically, you're being taken care of in the way that you would like for you and your family, long-term care is really worthwhile to look at. Okay, estate plan. This is a biggie, and this is one a lot of people say, I'm not wealthy, I don't need it. I don't have $5 million, I don't need an estate plan. An estate plan is your gift to your beneficiaries that at a time when they've just lost you and they're dealing with grief, and they may not know where all the pieces of your financial life are. They're not in a position where they're trying to uncover it and ferret it out. So having an estate plan, no matter what your net worth is, and I have heard attorneys say, if your net worth is over $100,000, you should absolutely 100% have an estate plan. Well, the average house nowadays is worth well more than $100,000 in most communities. You should have an estate plan. So just think of it as a gift that you're giving after you're gone to your family, so they're not in a position of trying to second guess what you wanted. They're not in a position of perhaps being considered the bad guy in the family because they're making decisions where their siblings think that you would have wanted something else. And you can see how this can become like untenable or create conflict in families. It's really easy to resolve it while you're still around by putting your plan in place and letting your beneficiaries know this is what it is and it's taken care of. And these are hard discussions. I get it. My siblings and I have these all too frequently now. But in that, we are making sure that when we're in the hard times, like the really hard times of losing someone, we've laid the foundation. And I so want that for you. Lay the foundation so the people you love know what you wanted and they're not, on point or second guessing or having a more difficult time with your loss than need be. Specific points on this. So that's my estate plan soapbox. That specific points, be clear about your beneficiaries. More and more important when there are blended families. Sometimes people don't realize in the situation of a blended family. So say a person has, as I do, say you have 3 children and they remarry, and that person also has 3 children, and I pass away too soon, but I'm married and my estate flows to my spouse, not to my children, unless I've made other plans. And then if he passes away, his estate, including my assets, goes to his children. That is often not the intent, but usually, and every state can be different, and I'm not an attorney, but you want to know and trace how things will flow versus how you want them to flow. And if you want them to flow differently, all you need to do is have the proper legal documentation. And then, most often missed, make sure that you execute that by changing your beneficiaries to whatever the legal documentation is. And what that means is, if I do my paperwork, I have a will and a trust, and it's a beautiful document and it is wonderfully legal and perfectly appropriate. And if I don't change my beneficiaries, it's worthless. So having the will and the trust made is only half the plan. Then you need to go in for all of your assets and make sure that they are titled correctly so they flow into the trust. And then the trust takes care of paying out the beneficiaries as you instructed. What happens if you don't do that is it still can go to probate. Probate, depending on the state, some are super fast, some states. Others, I came from Illinois and I'm now in Tennessee. In Illinois, my understanding was 6 months to a year if you're in probate. The attorneys I talked to there said it was about $30,000 you might count on paying in fees to get it through probate. So it might seem like tricky or expensive to go, oh, it's going to cost me $1,500 to do my estate plan. But I don't know, $5, $10, $20, $30,000 of your estate could just go to legal fees if you don't do that in advance. So have a will and trust. Just see what the rules are and figure out how you want everything you've worked for to pass on through your family, and have a lawyer help you write that out. Look at your beneficiaries and how you want your estate allocated to them, and make sure that that's written down and clear to them. Like I said, blended families, we have a 50% divorce rate. I do a lot of work in divorce. Blended families are very important to look at how you actually want things to flow from one side or the other through the family. Always look at it if you move. So if you're in New York and you move to Florida, look at the different rules, and do you need to restate your estate plan in the state where you reside? You may not, but check into it, especially if you move to a state that has more beneficial rules. Also, in an estate plan, this is a really good place to leave a legacy to charity if that's important to you, and you can designate it in that. So, you know, it might be a scholarship in your name for something that you're passionate about, whatever it is. You can also, especially if you have life insurance, check to see if you can designate a charity as part of your life insurance. Some, if you ask, have a charity rider on the life insurance, that if it's a policy of a certain amount, you can say to your agent, I would like that. And it's just tacked on. So you get to leave a, you know, cost-free to you bequest in your name to a charity as part of the policy. So you can look into that as well. Do we have a number 10? We do. Life insurance. So we just mentioned life insurance. Life insurance is your gift to your beneficiaries when you pass away. There are many different kinds of life insurance. The biggest difference is some are term. It's like renting. It's going to expire. Only about 3% of those pay out because usually they expire before the person passes away. And then you have, we call it lingo-wise, permanent life insurance. There are 4 different types of that. The difference in the permanent life insurance is it has a value. Think of it as a piggy bank inside there, and the different types of life insurance depend on what that piggy bank money is invested in. Ideally, if it's built correctly, that piggy bank is funding your life insurance forever, thus permanent, but you want to do checkups on it, because if something in the investment isn't properly funding your life insurance, it can expire. You don't want to be surprised by that. The other thing is, I see this with long-term care too. Someone will be in their 50s, 57, nearing 60, and they go, I'm going to look into long-term care. I'm going to look into life insurance, but I'm not going to do that till later. Every year you wait, it costs you more, plain and simple. They go on underwriting tables based on age. It's going to increase every year. because your life expectancy decreases and the probability that the life insurance company has to pay somebody increases. So don't wait too long. If you think it's something you want to do, it's not going to get more affordable if you wait. So look at it now. The other thing that can happen is you can't get it. So if you're insurable now, you're guaranteeing your health rating. If you wait, then you might not be able to get insurance, and it can be something that you thought was nothing. So how are we time-wise? I will share a very small story of myself. I had a lot of life insurance, but I had life insurance, and I was at a checkup with my doctor. I have a heart murmur, which a huge amount of women have, no big deal. And she's like, I don't hear that murmur anymore. Let's just run this battery of tests and get it off your record that you don't have it anymore. I was like, okay, cool. You're the doctor, do your thing. Well, we did that. And it turns out that I have a condition called atrial septal disorder, which means that my heart is perforated. It means nothing to my health. I feel no different. The only thing in life it means is I can't scuba dive, and I'm okay with that. I like snorkeling. So what it also means is I can't get life insurance. I mean, as a health condition, it's a check the box. I feel perfectly healthy. I can do my things and go through my acts of daily living. But from a health insurance standpoint, or if I get it with this new condition on my record, I have to disclose it, and it's going to cost me a whole lot more. And that was a totally unintended consequence. All she meant was, let's get this off your record. Like, we don't need it anymore. But what they uncovered was something entirely different. It impacts my life insurance. So if you're considering it, I would just say, do it now. You know, there are a ton of options out there. A lot of them have long-term care riders. You can like take care of two things in one. But it's not going to cost you less. And there is a chance, because life happens, that you might not be able to get it later if you wanted it. And with that, I think we ran through all of our things.
Yes, we've covered all our 10 items. Well, I know that we do need to wrap this up now. So what I will say is, if you did have a question, we weren't able to get to it, go ahead and leave your contact information as well. And we will try to reach out to you and make sure that that gets addressed. On behalf of Advice Chaser, we want to thank our speaker and for the organizations that have worked with us to bring you this webinar today. Thank you so much for attending. Look for an email soon with a link to the replay of this event, and you're welcome to share that replay with friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.
Bye, thank you.